So one of the most common questions that we field is, should I contribute on a pre-tax or post-tax basis for my retirement account? Does it even matter? The answer is yes, it definitely matters. So let's back up and clarify the choice. A pre-tax retirement account means that you're taking a deduction against your income today. You're deferring paying the tax to a later date. The presumption is that your marginal tax rate will be lower in the future than it is today. A post-tax contribution to a Roth K or a Roth IRA is an after-tax contribution that will grow tax-free. Since the amount contributed is after tax and the growth is tax-free, withdrawals from these accounts are completely tax-free if you follow the distribution rules. So to determine whether you should make a pre-tax contribution or an after-tax contribution, we need to consider your current, future, and retirement incomes in the applicable marginal tax rates. In general, if your marginal tax rate today is the same as your marginal tax rate in retirement, then the net after-tax amount that you will have in retirement will be exactly the same. This may not be intuitive, but that's just the way the math works out. So the key question is whether there's a difference between your current marginal tax rate and your retirement marginal tax rate. To figure this out, we take your age into consideration. The younger you are, the more likely your income will increase over time at a rate that's greater than inflation. Generally, as you progress in an industry, gaining knowledge and adding more value, your income will rise faster than inflation. Depending on the degree of ascent, you can migrate several marginal tax brackets throughout your career. If you're later in your career, then it's more likely we will want to make a pre-tax contribution. You're likely at a higher marginal tax rate than what your marginal tax rate is going to be in retirement. So let's look at some specifics. On your screen, you can see the standard deduction in income tax tables for someone who is single and also for someone who's married filing jointly. The brackets for single are exactly half of those for married filing jointly. To calculate your marginal tax bracket, you compare your gross income for the year to the tax tables. You add the standard deduction to the tax rate amounts. The standard deduction is effectively a 0% tax rate. Then you compare your income to the tax table plus standard deduction to establish your marginal tax rate. It's important to note that if you're dipping into a bracket, $1,000, $2,000, $5,000 into a bracket, it will not take much in the way of pre-tax contributions to bring you down to a lower tax bracket. So you may want to contribute both on a pre-tax and a post-tax basis. Please be sure that you are using the correct gross income number. You've got to account for current contributions to pre-tax retirement accounts, and also employee paid health insurance premiums can also lower your taxable income. So just make sure you're using the correct number. So step one is to determine your current marginal tax rate. Then we use financial planning software to determine your estimated income in retirement, taking into account tax types of the sources of income while you're in retirement. Given the estimate and the fact that tax tables historically increase with inflation, we can make a pretty good educated guess at your marginal tax rate in retirement. Then we simply compare the two. If your current tax rate is higher than your estimated retirement tax rate, that would indicate using a pre-tax contribution is most beneficial. If your current rate is the same or lower than your estimated retirement rate, that would indicate making Roth contributions. We recommend using a Roth contribution if your marginal tax rate now and in retirement is the same. And this leads into our other considerations. Changes to the tax code are also known as legislative risk. Congress controls how we're taxed, and they seemingly change the tax code every year. There's always a possibility that a change is made that will impact your net or spendable income in retirement. You can avoid most legislative risk by contributing to a Roth-based accounts. The after-tax, growing tax-free nature of the accounts insulates you somewhat from changes in the tax code. However, there has been some discussion around a wealth tax. A wealth tax would likely be applied to Roth IRAs, so even though a Roth account is currently tax-free, it is not 100% immune from legislative risk. The tax code could be changed to tax it. Giving and inheritance. Another consideration is what happens when a pre-tax account is inherited. A newly inherited pre-tax retirement account is subject to RMDs, required minimum distributions. Under most conditions, the accounts are subject to a 10-year rule, meaning that the funds must be distributed to an heir over a 10-year period. As such, it is common that an adult child would inherit an IRA during their peak earnings years between ages 55 to 65. The RMDs add to the heir's income, potentially being taxed at a marginal tax rate that is much higher than the original owner's marginal tax rate. As such, we recommend considering the marginal tax rate of the beneficiaries as well as the account owner, which leads us into Roth conversions. We do suggest reviewing taxable income on an annual basis. As income varies from year to year, it is appropriate to perform Roth conversions. A Roth conversion involves moving funds from a pre-tax account to a Roth IRA account and paying the corresponding tax for the applicable tax year. You can convert any amount, and the amount converted does not interfere with your ability to contribute to a Roth. Can be very useful in managing the tax implications of RMDs post-inheritance. Now, if you're receiving an inheritance, be aware that depending upon the account tax types inherited, they may add to your taxable income. If possible, I suggest having a discussion with the account owner to determine whether Roth conversions should be utilized in advance of someone's passing. TCJA income tax rates, or the Tax Cut and Jobs Act, went into effect in 2017. At the end of 2025, the current marginal tax rates are set to expire. The rates will automatically revert back to the pre-2017 rates. As such, the 12% bracket will increase to 15%. The 22% bracket will increase to 25%, and the other brackets will go up as well. The potential change in brackets, again, is an indicator to make after-tax contributions through 2025. We recommend, if in doubt, to make the after-tax contributions and reassess in 2026. So that brings us to inflation. Both tax rate tables and standard deductions are indexed for inflation, so they automatically increase annually. So if your income is rising at roughly the rate of inflation, your marginal tax bracket will likely remain the same. Okay, I hope this helps. Please reach out if you have any questions. Thank you.